Welcome to Investors Insights. Our topic today is, can the market hold the line? Whether you're a bull or a bear, today's discussion will give you insight on this market, the volatility, rising interest rates, as well as trends that we're seeing. So stay tuned as we have conversation here with my distinguished colleagues, Bobby Norman, Trey Booth, and Ty Miller. Gentlemen, good morning. I really enjoyed our meeting that we had. And when we came up with the topic, can the market hold the line? I thought your insight, your charts were outstanding. So on that note, Bobby, several people have been calling in here having discussion like, if interest rates continue going up, what's the impact of that in relation to the market? Your charts were great this morning. Talk about that.
Yeah, with the Treasury yield spiking higher the past few weeks, we've had some questions around higher interest rates and market performance. So what we did is we took a look back from a historical perspective, and as you can see in the chart here, on how the S&P 500 index has performed in calendar years when the yield on the benchmark 10-year Treasury note finished the year higher than where it began. And so from 2000 to 2022, last year, there were 10 such years, as you can see in the chart, where the S&P 500 posted a positive total return in 8 of those 10 years. So that's a positive thing. And so one of the outlier years was obviously last year in 2022, we saw a record jump in the 10-year Treasury yield with the S&P 500 having a tough year. So even though rates are rising this year, history says that that's not necessarily a bad thing for the markets. And so something we're watching carefully here.
It's the old saying that history doesn't repeat itself, but it sure can rhyme. And we're seeing a lot of similarities here in this market. And then from the standpoint, Trey, you really interjected and brought some great insight on fundamental and technical analysis this morning. And I'm a big believer in it. Our whole firm is a big believer in that. And I know you are too. So show the folks the charts and how we're watching the volatility and movement of this market and what it tells us.
Yeah, absolutely. Thanks, Greg. So when we're talking about holding the line, we're usually, referencing a technical line that we're trying to see if the market can stay above. So this chart just shows the S&P 500, which again is the 500 largest stocks publicly traded in the U.S. So it's the most important equity index in the world. You can see here that it stayed below a falling red line where the highs kept getting lower and the lows kept being lower. So all of last year, the market would rally and then fail, rally and then fail. That started the turn where we had a higher low at the beginning this year. And the market rallied and then the market fell and then we held that rising line. And so can the market hold this line going forward and continue a new pattern of higher highs and higher lows? And so this is the technical data. Typically, technical is a good indicator of fundamentals that you find out after the fact. Technical tells you what's happening now. Fundamentals are good backward looking. So this other chart shows fundamentally what happens. So this shows the market's performance during earnings season. And so the last 3 rallies we've had in the S&P 500 have been during earnings season. So the micro data of just core company earnings has been very positive. The market has really rallied on that positive news, only to fizzle when the macro data took center stage. The macro data we're talking about, inflation. I think everyone's well aware that inflation has been an issue last year. The Federal Reserve policy. Everyone is well aware that the Fed has been pushing prices down, and then wages and how those relate to inflation of the Fed. So we've passed through another earnings season recently. The market has rallied again, and we're about to hand off to the macro. And so can this line hold as we do this handoff from micro, which is positive, to the macro, which over the last 12 months has been very negative. We've got jobs data out on Friday, inflation data out next week, and the week after that, the all-important Fed decision on interest rates. So we've got a lot of market macro data coming at us. So it'd be very important to see if we can hold this line and get a good rally to start the year off.
Yeah, and the information you're talking about, we constantly are having dialogue in our social media as well, on Twitter, Facebook, LinkedIn, YouTube, on our podcast. The information that Bobby and you are giving, Trey, we want to communicate that to our clients so they can see behind the curtain, as we've talked about in previous vlogs, as to what we're looking at. And folks, hang on here because we're getting ready to give you some great insight with this information we've already given you. Ty brought up about changes in the S&P 500. So you've heard Trey talking about the S&P 500 and how we're tracking things. But Ty, you brought up something big that on March 17th, and we're not talking St. Patty's Day here. We're talking about market scenarios of changes that can occur in the S&P 500. It's great insight. Go ahead and talk about that.
Yeah. So of course, S&P 500, 500 largest companies in the U.S. here. The Global Industry Classification Standard, or GICS for short, is doing a realignment. They're in charge of realigning the S&P. They're doing a realignment on March 17th. So there's 11 sectors total. Those include things such as materials, industrials, healthcare, and, as we're going to see here, tech and financials heavily involved. So there's going to be over $1 trillion worth of money movement being realigned in the S&P. Now, it's not coming or going. It's just being realigned in those same 500 companies. But how does that work? Well, as you see in this chart here, a lot of these, the fintech companies, as we know them, these include, the credit card companies, as well as some of the newer fintech players. They're moving from tech to financials. That seems to make a lot of sense. They deal mainly with the financials. They just kind of bring that technology aspect to it. But every sector needs technology these days. And then, of course, there are some more, coming from tech, going to the industrial sector. And then we have some big box retailers and some discount retailers going from discretionary to the staple sector. And so what's that? Again, that's over $1 trillion worth of movement here. And what's that going to look like? Well, as you see in this next chart here, it's going to align us more with the rest of the world. And what do I mean by that? Well, the tech sector is going to lose about 3%. And so they're going to come down from about 25% of a sector weight of the S&P. Again, there's 11 sectors. Tech is 25% of it. It's going to come down to about 22-ish%. Financials are going to get basically a 3% bump, go up to like that 15% range. And so, compared to the rest of the world, like I said, we were like 25% tech. Even, the most tech heavy, like Japan, they were about 18%. I mean, you look at like Europe and China, they're at 7 and 8%. So, very interesting that we were so tech heavy, and we're kind of reducing that just by realignment. And Trey brought up an interesting point of what that's going to mean kind of going forward and for those few days there. And so I'll let Trey talk about some trading and volatility.
On total, it doesn't change anything, right? All it's changing is the constituents of these 11 sectors. But that is going to create hundreds of billions of dollars worth of forced trades. We have a lot of rules-based investing in this world now. It's not as much as one person picking one stock and buying on fundamentals. There's trillions of dollars that track rules-based, and so they may want to own Visa, but if Visa is no longer in the tech sector, they have to sell it. And if you own a financial sector, you have to buy it. And so there's no human decision behind that. That's just hundreds of billions of dollars worth of forced trading is going to happen in the next couple of weeks, likely around that March 16th day. That's going to make the market look a lot more volatile, make the market look a lot more like there's a lot more activity. And all it is moving the deck chairs around on a boat. And so I think there's probably going to be a lot of press around record volume or record this, record that, and it's not as much of an importance of any fundamental decision making, but it is important for those companies going from one to the other, and it is important for those sector managers who own these companies just today, but won't own them a week from now. So a lot of moving parts there, but it's going to create a lot of friction for a few weeks here.
Now, Trey, when you talk about Visa, for example, you're not recommending the stock. You're just saying it's part of the S&P 500 index, and that's one of the stocks that will see a change. Is that correct?
Yeah, absolutely. This is not a recommendation. This will not impact a stock long-term or short-term. This is just a notation that statistically one stock is moving from a sector to another sector.
Yeah, it's being required by those that oversee the S&P 500.
That's right.
Because people need to realize the S&P 500 today is not the S&P 500 when we first started.
Absolutely.
And this has been an evolution in relation to our economy as industries change. It used to be railroads dominated and other types of industries like that. Today, here we are talking about technology and readjustments there. So it'll be historic, we think, folks, and something that you need to be aware of and bring it up in conversation with people. I think you'll find out most people don't realize that's getting ready to happen, but you do because you've watched our vlog. We want to keep you informed. These are the ideas, strategies we're looking at to coordinate the portfolios in relation to your financial blueprint. So we hope you have a great week, and we will keep you updated, and we hope spring comes early and we all continue to celebrate, and somewhere along the line, and we'll celebrate St. Patty's Day this month, and all have a good first quarter. You have a great week. We'll look forward to talking to you soon. Thanks.